The world economy tripled in size between 1990 and 2009. And in the early aughts, global oil demand boomed, particularly in China. The supply side, however, struggled to keep up with rising consumption. New European fuel regulations required lower sulfur levels, which complicated supply chains and increased dependence on producers of light crude, like Nigeria. Increasingly expensive steel pipe, drilling rigs, oil field services, and cement sent oil production costs through the roof, limiting production growth in non-OPEC countries, like Russia. On top of this, the disaster of neoliberal economic shock therapy after the fall of the Soviet Union brewed President Putin's antagonism toward private oil companies, foreign capital, and foreign technology, dampening the country's output. Mammoth oil fields in the North Sea and Mexico began declining, pushing oil prices upwards of OPEC's $22 to $28 price band. But after its misstep in the wake of the Asian financial crisis, OPEC feared another production hike. Besides, as oil producers, higher oil prices troubled them less than lower ones. But demand was ceaseless, and prices kept increasing. Crude oil futures trading, establishing the sale of a certain quantity of oil at a specific price within a particular time in the future, has aided in forecasting longer-term oil trends, and by the 2000s, rising futures prices indicated that a tightening market was here to stay. In January 2005, Saudi Arabian oil minister Ali al-Naimi raised the kingdom's maximum production capacity from around 11 million barrels a day to 12.5 million barrels a day. This diminished the world's spare production capacity to less than 1% of global oil production. This, of course, weakened OPEC's power to absorb price volatility. In February 2008, violence, strikes, and commercial disputes in Venezuela, Iraq, Nigeria, and the North Sea pushed crude oil prices above $100 a barrel for the first time. By June 2008, the subprime mortgage crisis forced the US into recession, and the highest oil prices ever forced 8 airlines out of business. Goldman Sachs even predicted an average oil price of $200 a barrel in 2009. But OPEC officials affirmed the sufficiency of oil supply, blaming price volatility on oil speculators, though there was no evidence of this. At an emergency summit on June 22, 2008, Saudi Arabia tacitly admitted to a supply shortage by announcing a production hike. But then, on September 14, 2008, investment bank Lehman Brothers declared bankruptcy. The US recession went global, slashing consumer income. Oil prices crashed. The oil market was out of control. The credit crisis may have defined the Great Recession, but expensive oil certainly played its part, exacerbating inflation, interest rates, and energy costs in oil-consuming countries. So, how much oil do we still have to work with? The 1.7 trillion barrels we know about, plus all anticipated discoveries, give us enough oil to last around 50 years.